does have a YouTube channel, Marquette Inc. And what we do right down here is we'll be recording these live, and then we also archive them. So if you ask questions, which we encourage, speak relatively loudly. They'll try to repeat the question as practically as possible. And then what we'll do, you ready for about a 7-minute pitch?
Yep.
All right. This is Connor Jones, and Connor Jones is going to be presenting Delek,
Yes.
an energy company. What will be behind you, just so what you know, is Bill Walker, who's the co-teacher at AIM. He will have FactSet loaded, and he'll be putting up various statistics on the company. So I hope you have the right ones in your write-up.
Hope FactSet has the right ones.
Shay, all set? Okay, good.
All right. Hello, everyone. My name is Connor Jones, and I'm currently a junior in the AIM program studying finance and covering the domestic and international energy sectors. The company I'll be pitching today is Delek US Holdings, ticker DK. Delek US Holdings is an integrated downstream energy business that is focused on petroleum refining, transportation, storage, and distribution of crude oil and refined products, as well as convenience store retailing. Delek operates through 3 segments: refining, logistics, and retail. The refining segment processes crude oil and other feedstocks across 4 refineries and 2 biodiesel facilities in Arkansas, Texas, and Louisiana. The logistics segment transports, stores, markets, and distributes products for the refining segment and third parties. The retail segment includes approximately 300 convenience store sites in West Texas and New Mexico and provides various grades of gasoline and diesel, along with food, drink, and merchandise under the 7-Eleven brand name. Delek was founded in 2001 and is headquartered in Brentwood, Tennessee. Delek US Holdings completed their IPO in 2006 and has established themselves as a vertically integrated and diversified downstream energy company. The integration between Delek's operating segments has allowed them to maintain performance through downturns in the energy industry and take advantage of current energy market conditions. An oversupply of crude oil, coupled with a shortage in takeaway capacity, has driven down the price of WTI crude oil, leading to increased crack spreads, which are the differences in price in crude oil and the petroleum products that are refined from it, as well as increased differentials in prices between oil types. Delek benefits from this due to their cost advantage over peers that is derived from their ability to refine different fuels depending on current market conditions. Since 2016, revenue has increased 134% and net income has increased 218%, allowing Delek to continue their seeking out accretive acquisitions, increasing dividends, and buying back shares. Delek currently has access to an aggregate 1,467 miles of transportation pipelines in the southeastern United States and West Texas, and is currently in a joint venture project with Energy Transfer Partners, Magellan Midstream Partners, and Marathon Petroleum's Logistics Limited Partner to build a pipeline to the Gulf Coast. Delek's ability to use their logistics segment to transport discounted, locally sourced oil in the Permian Basin led to a 40% increase in their contribution margin in the logistics segment in 2018. During 2017, Delek acquired Alon, giving them access to about 300 convenience store sites under the 7-Eleven brand name, which resulted in a 228% increase in retail segment revenue over the past year. Based on the company's vertical integration between their operating segments and flexibility in their refining capabilities, enabling them to maintain performance through market cycles, it is recommended that Delek US Holdings be added to the AIM Equity Fund with a price target of $55.15, representing a 49% upside. And now on to my drivers. Delek's perpetual license agreement with 7-Eleven. On February 7th of 2018, Delek purchased the remaining partnership units of the Alon partnership, making them the largest licensee of 7-Eleven in the United States. They now operate approximately 300 convenience store sites, which market motor fuels throughout Central and West Texas and New Mexico. In the third quarter of 2018, Delek reported increases in same-store merchandise sales of 3.7% and a 4.4% increase in same-store fuel gallon sales from the third quarter of 2017. Substantially all of the motor fuels sold through the retail segment are supplied by the refining segment, giving them the ability to manage margins by producing different grades of fuel depending on the market and highlighting the integration of their operating segments. IMO 2020. The International Maritime Organization announced a reduction in the maximum sulfur content of marine fuel consumed on open oceans from 3.5% to 0.5%. The primary replacement for this sulfur content is expected to be diesel, leading to an increase in diesel crack spreads. Delek has an industry-high diesel capacity of 44% throughput at their refineries, allowing them to utilize these price differentials to increase revenue and expand their margins. Financial flexibility. Delek is well positioned amongst peers in terms of free cash flow and debt financing. At the end of the third quarter of 2018, Delek had about $1.1 billion in cash on a consolidated basis and $753 million in net debt. Their strong balance sheet enables them to continue their history of successful accretive acquisitions, returning cash to shareholders, and seeking out other strategic investments. In 2018, Delek's total cash return to shareholders was $445 million, with just under $68 million of authorization remaining from their initial announcement last February. In addition, the board authorized an additional repurchase program worth $500 million in November of 2018, highlighting their commitment to increasing shareholder value. Now on to my valuation. In order to reach an intrinsic value for Delek, a 5-year DCF was constructed. Using a terminal growth rate of 1.5% and a WACC of 8.89%, an intrinsic value of $56.69 was reached. A sensitivity analysis on the terminal growth rate and WACC ranged from $49.65 to $66.09. Additionally, a PE multiple valuation was calculated. Using a 2019 estimated EPS of $4.84 and utilizing a blended average PE multiple of 12.94 times resulted in an intrinsic value of $62.65. Finally, an EV to EBITDA multiple valuation was conducted by using a blended average EV to EBITDA multiple of 5.87 times, resulting in an intrinsic value of $49.85. By weighing the models 40-20-40, a price target of $55.15 was reached, resulting in a 49% potential upside. Delek pays a dividend yielding 2.9%. And now, in the interest of time, I'm only going to touch on 2 of my risks. Commodity price fluctuations. Delek's refining margins are dependent on the prices between crude oil and feedstocks, both of which are volatile. There's a significant change in these prices. It could harm their profitability and margins. Separated RIN tickets. While Delek is able to obtain many of the RINs required for compliance with EPA guidelines, they must also purchase some on the open market. If the RIN prices increase and Delek cannot pass this cost on to their customers, their profitability could be harmed. And finally, I'd like to touch on management. Ezra Uzi Yemen has served as chairman of the board since 2012, as CEO since 2004, and president since 2001. He also previously served as treasurer from 2001 to 2003 and secretary from 2001 to 2005. Kevin Kremke has served as CFO and executive vice president since 2017. Prior to joining Delek, he served as the CFO of Siner Resources Corporation. And with that, I'd like to open up the floor for questions.
All right, we'll start with Nick and then Nate.
So you talked a little bit about like acquisitions and their strategy there. Did you model in inorganic growth going forward? And if not, can you talk about what it might look like if you did?
I did not model in inorganic growth because they have not given any guidance as to whether or not they're currently seeking out any new acquisitions. They generally won't go through with a project unless it is 5 to 7 times EBITDA multiple. And so they haven't found any currently. So if I did model that in, which you can see what happened with the acquisition of Alon in 2017 and 2018, those increases were driven by that acquisition of Alon. So if they were to pursue an acquisition like that in the future, it would obviously increase the revenue growth and margins.
Good, any follow-up, or is that fine?
I do have one more.
Okay.
So pipeline sales, or their increase in their pipeline, it drives 29% increase in revenue.
Yeah.
So do you see them kind of like going more into the logistics segment, trying to expand? So they're only at 6% there. Do you see them kind of growing that segment or staying right around that?
I don't expect it to go too much higher. Currently, like I mentioned, they're in a joint venture project with a couple other energy companies to build a pipeline to the Gulf Coast. So that's the only one that they're currently doing right now. And then there's a lot of midstream pipelines coming online in 2019 and 2020. So I don't think that they'll be pursuing too much growth in that area due to an already oversupply of it coming on.
Yeah, so your WACC in here is almost 9%. You have the WACC on backside 15. I know you don't usually follow that, but let's walk through your WACC calculation.
Yeah, sure. So when I calculated my WACC originally, both FactSet and Bloomberg had around 8.8, as well as the sell side reports that I read, which is around what I have. I assumed a risk-free rate of 2.71 based on the 10-year treasury, and then a beta of 1.24. I had an expected market return of 10%, and that led to a market risk premium of 7.29% and a cost of debt around 4.13% with a cost of equity of 11.75%, and I got 8.89.
A lot of nice questions. Let's keep it going.
So I noticed that in 2019, you have a revenue growth of 6 and then it declines in 2020. Can you just give me some guidance to what the next 3 years look like?
Yeah, of course. So top line, they're not expecting much growth after this. Well, they'll still grow, but that's the inorganic levels. Based on their projects that they're investing in right now, they're growing their midstream operations and they're expecting that to generate and just add to margins. So they're expecting to grow their bottom line more so than their top line and work on increasing the margins there.
Yeah, in terms of your International Maritime Organization driver, do you have any numbers as in like what size is this market that could possibly open up, or like what the expected revenue impacts are based on guidance or any other predictions at all?
So there's been no guidance so far. What they did highlight is, like I mentioned, it will increase diesel crack spreads, of which they have 44% throughput capacity at their refineries, which is the highest in the industry. So they won't have to do as much work to update their refineries to be able to comply with this new regulation. They're not quite sure what the impact will be, but I think we'll start to see it towards the end of 2019 and then fully in 2020 when it comes online.
Bill, and then Eric.
Do the Venezuelan sanctions have any impact on this company?
No, 7-Eleven's ties with Citgo in Venezuela do not affect their license agreement with Delek.
But on the refining side?
Oh.
Inputs to the refining?
No, they're completely in the United States, so that doesn't affect them.
Eric.
So for their refining business, is the revenue they make based all on the price of oil, or is it fixed?
Yeah, it does depend on the price of oil, but they're able to utilize different oil types, which I mentioned before. They're able to source locally discounted oil from the Permian Basin, as well as those increased in price differentials. Depending on what oil they're refining, they can take advantage and adapt to that to maintain their margins and revenue.
Can you talk about the relationship between DK and DKL and how you might model that in?
Yeah, so the logistics segment is their limited partner, of which they own about 94.6%, and the whole 2% of the general partner interest in it. And so I modeled that in on, I had some consolidated basis numbers in my model, but also they have mentioned, so Valero company recently bought out their limited partner, and Delek has talked about how they still currently see some value in holding it as a public company, but are not opposed to in the near future buying it out like Valero did. So I wanted to kind of project that going forward if they were to follow that trend in the industry. Yeah. Yeah.
The stock price has pretty much dropped almost 50% since mid-May. Is that, can you explain that, or is that mainly just due to the drop in the price of oil?
It actually doesn't have as much to do with the drop in price of oil as it does in the whole downturn of the market towards the last year. So like I mentioned before, they have a high beta of 1.24, and they're trading at a historic low right now due to that market downturn. And then also with everything going on in the oil industry and the prices decreasing in the Permian Basin, some people, investors, did not like the sentiment towards their Permian Basin exposure. However, it was highlighted that a lot of those company or investors are focused on the tightening differential between Midland Cushing and WTI, which is not what drives their business. Their business is driven through the price differential of Brent and WTI. So they should realize that, or they're expecting investors to realize the mispricing, and then it'll go back up to where it was.
All right, last question. If you, 6 months from now, do not realize this price and it's down substantially, what do you think would be the cause of it? What do you think is the biggest potential risk to the future?
I think tightening in the oil, so I think a tightening in the oil supply or the price differential between WTI and Brent oil, any significant tightening in that would be the most significant impact and harm the company.
All right, here we go. Time to go. All right, Gino is next going to present a company that's in the consumer staples industry. That was energy. Each student has their own sector. And Gino's, any samples, Gino?
Unfortunately not today.
Might be the one name you recognize in the portfolio.
Just before I begin, in my stat box, the WAC should be 6.83, not 7.64. Awesome. So good afternoon, everybody. For those of you who don't know me, my name is Gino Piscopo. I'm a student in the AIM program studying finance, and I cover the domestic consumer staples sector. Before I begin, I'd like to thank my family for watching. Today I'm pitching Hostess Brands, ticker TWNK. Hostess develops, manufactures, sells, and distributes sweet baked goods, or SBGs. Over the past century, with products such as Twinkies, cupcakes, Ho-Hos, Suzy Q's, and Honey Buns, Twink has amassed one of the strongest brand equities in the country. Moving on to my recommendation. With the SBG category representing $6.6 billion in sales of the larger $97 billion snacking industry, but since Hostess's reorganization in 2013, management has changed many key aspects in their operations, all in the scope of making the company more efficient. These changes consist of owning more baking lines, using third-party distributors, and acquiring key facilities. Through these changes, Twink has become more independent, which will result in margin expansion. This is pivotal to my investment thesis because the SPG category has only grown at a CAGR of 3.3% since 2013 and is predicted to grow at the same rate as population. We can see their strategy has already been working because from 2016 to 2018, sales grew by 7.9% and net income grew at 27.5%. On top of this, by owning their own baking lines, Hostess can easily swap products in and out according to consumer preferences. The research and development team is constantly surveying and testing new products. For example, in 2017, 3 new products, White Fudge Ding Dongs, Hostess Bake Shop, and Hostess Bakery Petites, increased net sales by $62.5 million. Also, Twink has been focusing on the breakfast subcategory, which accounts for approximately 51% of the SBG category. In a 2016 study done by Mintel, showed that consumers prefer portability as a key attribute to their breakfast items. This trend plays into the strengths of the product portfolio Hostess Brands currently has, such as jumbo muffins, danishes, and glazed donuts. Through their business model, these products will only become quicker and more efficient. Through all this, Hostess has maintained their impressive brand equity that has a 90% plus brand awareness. Despite this, Twink is currently trading at a discount with a better business model, growing market share, and widening margins. As a result, it is recommended that Hostess be added to the AIM Small Cap Equity Fund with a price target of $14.66, representing a 21% upside. For the interest of time, I'm only going to talk about my first 2 drivers and 2 risks, and field questions about future products and wheat prices. My first driver is an understated bakery acquisition Hostess made on February 1st, 2018. Twink acquired a bakery facility in Chicago alongside the Big Texas and Clover Hill brands. Since this was a dilutive acquisition of about 10 to 12 cents, the market traded down that day, but upon its announcement, management predicted it to be EBITDA positive in 2019 and to contribute around $20 to $25 million in EBITDA in 2020. Fortunately, the short-term loss caused Hostess to trade at a discount, even though there is large potential upside. For the short-term loss, Hostess will have long-term gain in the breakfast category, which is the fastest growing in the snacking industry. Secondly, Hostess moved from direct-to-store delivery, or DSD, to direct-to-warehouse, or DTW. Even though DSD is common within the industry, because of over $200 million invested in the past 5 years into Twink's manufacturing footprint, IT systems, and automated baking, Twink now has a superior centralized distribution centers that allow them to use third-party distributors. Because of this, cost of goods sold went down by 250 basis points in 2017. By owning their baking lines and using third-party distributors, Hostess fills customer orders quicker and reduces inventory on hand. Now into my valuation. In order to reach an intrinsic value for Twink, a 5-year DCF model was constructed using a terminal growth rate of 2% and a WACC of 6.83. An intrinsic value of $14.23 was reached. A sensitivity analysis of plus or minus 25 basis points on terminal growth and WACC ranged from $11.47 to $17.93. Additionally, an EV to EBITDA multiple valuation was conducted using a weighted average EV to EBITDA multiple of 12.5 times, resulting in an intrinsic value of $13.12. Lastly, a PE multiple valuation was calculated using a weighted average PE of 29.61 times, resulting in an intrinsic value of $20.61. By weighting the 3 models 70, 20, 10, a price target of $14.66 was reached, representing a 21% potential upside. Twink does not pay a dividend and reports Q4 or 2018 earnings this Wednesday. Lastly, my risks. Walmart represents 1/5 of Twink's net sales, so when Walmart deprioritized Twink's shelf space and decreased promotional displays, Hostess missed their earnings in Q2. In more recent news, Mr. Callahan, Hostess's CEO, has been quoted in the Wall Street Journal saying he has lobbied them successfully to display its products more prominently in more stores. Secondly, I mentioned how powerful Hostess's brand is. Any hindrances internally or externally can limit this power and will definitely be something to monitor in the future. Then quickly touching on management. Upon former CEO Bill Toller's retirement, Dean Metropolis served as interim CEO until Andrew Callahan was named CEO back in May of 2018. With more than 23 years of leadership experience at name brand companies such as Tyson Foods, Sara Lee, and Kraft Foods, Mr. Callahan will be an important asset for the business. I will now like to open up the floor to questions.
All right. Nick, looks like you're our lead off today again.
Can you touch on your short interest? And then I've got another question.
Sure. So the question was regarding short interest being at 16.7%. The short interest is pretty high right now. I think that has to do a lot with the acquisition and then a bid that they made on Famous Amos cookies off of Kellogg, and probably a little bit concerned about the non-controlling interest.
And then can you tell me what your weights are for your comps?
For my comps, yeah, 30, 30, 15, 15, 10 in that order.
Okay.
That adds up to 100, right?
So
Yep.
Can you just tell me why the first two are so high, like how both they are?
Sure. So the question was regarding my comps and why I weighted the first two higher than the others. And the answer to that is they were directly talked about in the 10K as direct competitors, and they both operate in the same kind of category of sweet foods that are packaged. And then the other ones I felt can give value and depict the company in the future, such as Tootsie Rolls and Dean Foods. And then General Mills, I just felt, being the size that it was, should have the least amount of weight.
A lot of questions coming in, so we'll make
Sure.
them fast and furious.
Let's hear it.
Can you touch on the operating income growth in relation to the revenue growth in 2019?
Sure. So the question was regarding operating income growth in 2019 by my growth in revenue. So in 2018, cost of goods sold was around 63%. And in 2016, it was 55%. And in 2017, it was 53%. So you can see just like a 10% jump. And that is due to wheat prices and gasoline going up in the first 3 quarters of 2018. So that jump in 2019 is just reflecting that such a big decrease in that cost of goods sold. And then moving on to 2020, you could see it kind of normalizing with that 3.5% growth in revenue. And then my margins expanding just a little bit to 4% in operating income.
Eric.
Your last driver mentions their innovative business model.
Sure.
Is this kind of costly for them, and how does that compare to their competitors' innovation?
Sure. So the question was regarding my last driver being innovative products. And like I mentioned in my write-up, because they own these baking lines and their R&D is actively involved with these consumers, they can switch products very quickly because of this. And if a product isn't selling well, they can switch that out very quickly and efficiently. And that's why it's innovative, because they're releasing products that are actually working. And it's actually Hostess's Sweet Centennial. The cupcake was released in 1919, and they released a birthday cupcake with the traditional swirl that we all know and love.
Well, that needs a buy, doesn't it?
In terms of your risk with Walmart, have they done anything to address why they've lost like shelf space and promotional displays? And like, are they going to be spending any more money with Walmart to get those back? It seems like with 20% of net sales coming from Walmart, that they would want to make sure that they're doing something like that.
So can you repeat the question?
Yeah, it's kind of like what are they doing to try and get that shelf space and promote and those promotional displays back from Walmart that you said they lost?
Mhm.
Big reason why they missed second quarter sales.
Yep. So the question was regarding my Q2 sales and Walmart deprioritizing their shelf space. And it was strictly just moving where Hostess was shelved at. And like I said, Andrew Callahan moving in as CEO wanted to really emphasize that he lobbied for moving that shelf space and having those promotional displays. And then Walmart moving into the online space more will help that, of course.
Yeah, so in your second driver, you talked about the shift from DSC to DTW. Like, how much more runway does this have? What's the part of the experience already?
Yeah, the question was regarding my second driver and if that was priced in or not. Yeah, so I think that is priced in a little bit, but I think there is more runway because as they only sell in the U.S. but are trying to expand in Mexico, United Kingdom. And with that, I think that distribution centers are going to have to be acquired. And if they can keep that third-party distributor by owning their own baking lines and keeping that direct-to-warehouse delivery method, intact, I think that has more runway as they expand geographically.
So moving on to your valuation a little bit here.
Sure.
Can you speak a little bit to your weighting with the 70-20-10 and your reasoning behind that?
Sure. So the question was regarding the weights of my valuation. And so when I was constructing my DCF, I felt comfortable with my estimates and sales because they're in line with consensus. And then with the margin expansion, I just think cost of goods sold was really high in 2018. And with wheat prices coming down because of Russia actually having a good harvest in wheat, I just tapered that down 100 basis points year over year. And I think I was just really comfortable with it. And I thought it was pretty conservative and gave that the highest weight. And then moving on to EV to EBITDA, that just strips away like capital structure and reliance on PP&E. And with my comps being the different sizes that they are and somewhat a little bit different sub industries, I felt that was a good valuation. And then just to have like a test on the other two, I thought PE was a good one and it yielded the highest amount. So I felt trying to be conservative as possible to weight that one the least.
Dr. Wall.
Understanding that we can't own warrants in this portfolio. Even when you think about the warrants they have.
Yeah, so the question was regarding,
I'd rather own those warrants or the stock if you had a choice.
if I can summarize your question, it's like regarding the non-controlling interests, the warrants that they have.
Yeah, no warrants are a product. They're like long-term options. Do you know anything about the warrants on this company?
I'll have to get back to you on that one.
He's a hedge fund guy. He would rather have the warrants than the stock.
Yeah.
Turns out you can buy them for $1. They're structured at 11.50, so you only lose $1 on the way down, but you make money on the way up. The reason it's important, we'll turn this into a teaching moment.
Sure.
The reason it's important is twofold. One, it's always good to look for other ways to own the same thing cheaper or to protect your downside, in my opinion. And two, in particular, for this particular presentation, the answer to your short interest is because all these hedge fund guys bought the warrants, and guess what they do with the stock when they buy it? Or they short a piece of it. It's called delta hedging. You protect a little bit of downside you have. And so the reason your short interest is high has nothing to do with fundamentals. It has everything to do with guys like me trying to protect their warrants.
Which about
you don't have any worry about the short interest.
Sure. Thank you.
Just what is a normalized operating margin for this? It looks like in 17 that there was a lot of extra ordinary reasons to have a 30% operating margin.
The question was regarding normalized operating margins. And I tried to normalize the income statement a little bit, and it was hard because of the different tax rates that they're using, and like you said, the different.
The tax rates are above the line operating.
Sure. Yeah. Just the different. I tried to normalize it, and in my model, I have around like 17%, but I think historically it's been like 14, all the way up to like 18.
One more follow-up question. The 20 million you have in your model. It seems to me that you just have, you don't have that in your model, given you mentioned earlier that there's some trends in that going into 19 that
Sure.
will possibly help them, not necessarily the acquisition. Correct? So is there 20, 25 million in the EBITDA in your 2019 expectations?
There's not.
All right, if you wake up 6 months from now and the stock is at 8, what happened?
I think probably delta hedging had an aspect to do with it. No, but I think just operationally, if they can't hit their targets, I mean, the play here is just like margin expansion, becoming more efficient, making sure that the products that are on the line are the products that the consumers want. And I think with how they're organized and set up, I think that they're efficient in that manner. And if they're going to consistently miss targets, I think that's going to be the reason to drive the price down. And we should.
You can monitor then. If this gets in, that's what you monitor.
Yep.
If something goes wrong.
Yep.
Go ahead, follow up.
Yeah, no, I was just going along that. I think that they're just efficient and they miss targets this year quarterly, but they report this Wednesday. So I think that would be something to look forward. But unfortunately, we own the stock before a Wednesday, and if they release after the trading day. So.
All right. Thank you, Gino.
Awesome. Thank you.
Daniel? Yes. You're going to present. Now we're going into the international part of the portfolio. We manage 2 equity funds, one a small cap fund, the other international. So, Daniel, all set?
Yes. Good afternoon, everyone. Thank you for being here. My name is Danny Smerz. I'm a junior in the AIM program studying finance and accounting. and I cover international financial services. Before I begin, when I was screening for a company, I was particularly looking for the following characteristics, including high GDP growth within that country, a reputation for honest and clear transparency, EPS and interest income growth above 10%, and ability to make loans to qualified parties. Through this process, I found HDFC Bank. HDFC Bank Limited, ticker HDB, is one of the largest private sector banks in India. HDFC Bank operates primarily in 4 segments: retail banking, wholesale banking, treasury, and other banking operations. HDFC Bank is part of an HDFC group of companies organized under HDFC Limited. In addition to their primary activities, they control 2 subsidiaries, HDB FSL and HSL. The former engages in retail asset financing and the later in brokerage and investment services. HDFC serves a broad range of customers in urban, semi-urban, and rural areas across India. This includes 4,787 branches, 12,635 ATMs, and 2,691 cities, serving over 43.6 million customers. HDFC Bank Limited was founded in August 1994 and is headquartered in Mumbai, India. Now on to my recommendation. HDFC Bank has become a steady and stable force within the Indian banking industry since their merger with Times Bank Limited in 2000 and their acquisition of Centurion Bank of Punjab Limited in 2008. HDB has experienced a 5-year interest income CAGR of 15%, a net income CAGR of 17.9%, and have kept their non-performing loans to total loans under 2.01%, far below their peers. 2018 showed similar figures with loan growth up 24%, as well as deposit growth up 22% year over year. Their focus on the rural customer base was evident through the opening of more than 900 branches in the last 2 fiscal years in uncharted areas. It is figured that roughly 150 to 200 banks are within the limits to be added every year. This is part of their continued initiative to integrate both rural and urban India. Beyond their expansion within the customer markets, HDFC Bank has demonstrated further penetration, and then that they account for roughly 25% of incremental market share in fiscal year 2018 with strong customer acquisition growth. Their robust payment engine has also served them well. In fact, HDFC processes over 20% of payments of the country while only having 7.5% credit share of the market. These advances will translate into greater operating efficiencies for HDFC Bank down the road. HDFC Bank is poised to benefit from its subsidiaries. The bank subsidiaries HDB FS now contributes 6.2% of the bank's consolidated loan book, while HDFC SEC is 5% of the bank's consolidated profits. HDFC is the best play in the current environment given their stable margins, healthy asset quality, and consistent performance. Because of this, it is recommended that HDFC Bank Limited be added to the AIM Equity Fund with a price target of $125.58, recommending a potential upside of 26.01%. Now on to my drivers. My first driver, strong middle-class growth. According to a Columbia Business School report, India's middle class is set to grow rapidly from 80 million today to 580 million in 2025, representing 41% of the population. They also have a diverse loan set of loans, with 53% being semi-urban to urban and 47% being rural. And specifically, they're trying to push these margins to 55% semi-urban, urban, and 45% rural, which ultimately will benefit their strategy of moving into rural markets. HDFC Bank Limited will be able to continue and grow their services within these segments, consisting of personal loans and credit cards of 22.7%, retail business banking, and farming. Something I want to touch a little bit more specifically on pertains to the advanced technology platform. So Trading Economics released a statistic stating that 66.5% of the entire population in India still lives in rural areas. Now, currently, rural markets represent 60% of new mobile subscription growth, and these rural markets are expected to reach 1.2 billion subscribers by 2020. So in light of this, recently HDB launched their Development Lite app, which serves as a bilingual mobile banking application that doesn't require internet connection, which will specifically benefit the route they're choosing to go. And those customers with intermittent or no connection will have their needs fulfilled. For those that are connected, they have launched BBC Initiative, a blockchain which will better protect customer identity as well. Furthermore, it will allow for improved customer experience with their artificial intelligence that they're also utilizing. On to my third driver, low funding costs and customer retention. HDFC Bank is among the leaders in low deposit costs within the Indian banking industry. In the past 3 years, they have driven costs of deposits down from 5.91% to 4.82% in fiscal year 2018. This has been largely attributed to the healthy proportion of CASA deposits, which have been in the range of 44 to 48%. So in driving down these costs, they've been able to earn stronger fee income and expand into other opportunities of income growth, especially in these rural regions. And their strong market share in credit cards is evident through 50% of personal loans generated through existing customers. For the sake of time, I'll skip my evaluation and briefly cover risks and management. My first risk, non-performing loan increase. So HEB's inability to monitor and control credit risk could result in an increase in non-performing loans. HDFC limited ownership control. The HDFC group currently owns 20.93%. And so and being able to somewhat control directors and what like that, that could also be impacted. And then lastly, access to capital markets. There are more stringent capital requirements, and if they don't meet them, could affect them in an adverse manner. And lastly, management. Mr. Aditya Puri is and has been the managing director of the bank since September of 1994. This time I'd like to open up the floor
All
for
right,
questions.
Eric, you're first. I got two quick questions. The first, can you just kind of touch on the regulatory environment in India and how it affects your company?
Sure. So overall, the regulatory environment, I would say is, with the adoption, I might watch the pronunciation, but Basel III, it did put more stringent capital requirements and minimum liquidity ratios in place for the bank. In terms of other specific things, there is a mandatory liquidity coverage ratio of 100% by 2019, as well as capital adequacy of 10.875%. So they are in a pretty regulated, controlled environment.
Quick follow-up.
So just real quick, I know a lot of times for banks, you use price to book as a relative valuation method. For yours, your price to tangible books as if your company's overvalued. Can you kind of just touch on that?
Sure. Yeah, that's correct. So when I was taking that into mind, yes, you're right. Yeah, typically price to book. But considering the loan growth of over 22% the past few years, as well as just following down into earnings growth, I felt like it's be more applicable to price to earnings to value the company, especially when it's comparable for a lot of their competitors within the industry.
I was wondering if you modeled out an excess return model and what that looked like if you did.
Sure. So I did attempt an excess returns model. However, when factoring the cost of equity times the book value of equity, it did, give a pretty high upside. So I didn't really feel comfortable into factoring that in. So yes.
Yeah.
Can you explain why you used a 5.5% terminal growth rate?
Sure. So overall, the GDP growth within India over the past 50 years has averaged about 7.2%. I know the terminal growth rates for the domestic stocks are usually in like 1 to 2.25% range. Taking that into consideration with India, I felt that was a fair number.
So on your first page here, I'm noticing that your insider holdings are at 0%. Can you go into that?
Sure. So insider holdings are 0%. I did see something 0.22%. I did put 0%. When I was looking into that, I didn't see anything definitive within the 20F, but I did notice that compensation for executives and stuff like that were included a sitting. So being on the board, they would receive a fixed compensation rate, as well as salary and bonuses. I didn't see anything specific to that insider holdings of stock options or anything like that. So
Mary Kate, you get to go next. I put the wrong picture of you up, didn't I? I owe you one, okay?
Your WACC is 9.21% and your cost of equity is 6.71%.
mhm.
What is your cost of debt, given that your cost of equity is lower than your WACC?
I really didn't look into debt too much. I focused mainly for a DDM. You're going to use cost of equity. So taking that into account, that's what I used.
Teaching moment, sometimes the cost of debt for a bank, you have to remove, you only want to focus on their actual cost of long-term debt, not what they're paying on deposits. So sometimes it's a little tricky to get a whack. Do I get a comment on it?
Question.
Okay.
Comparables have, you look at the loan portfolio doesn't appear to be very good for some of the other competitors. It looks like their losses are fairly substantial,
Mhm.
possibly because of their loan portfolios.
Mhm.
Yet you have the non-performing loans of 1.2% compared to a peer group of 6.7%, some as high as 12%. So do you worry that the portfolio is not appropriately, the loan portfolio is appropriately valued?
No, I mean, these are all, there's some government-owned banks that I included as peers, and then also some privately owned like HDFC in terms of sector. So I felt it was a fair evaluation in that regard.
Michael.
I have a couple quick ones. I have to imagine we don't have a whole lot of exposure to India in our international
Mhm.
portfolio. Is that pretty accurate?
Correct.
All right. And then, as someone who used to cover international financial services, I'm wondering what your sell recommendation would be.
In other words, he doesn't want you to sell his stock.
So currently we're underweight. I'd sell the iShares ETF.
Dr. Wall.
I want to compliment the class because the group out there, because you're right, banks, the reason we measure price to tangible book value is we're looking for the quality of the assets. And given that we see bad quality assets in the comps, it's likely that this is a, you should have relevant fears that this is a repeat of China or other emerging markets where you have things trading for 30 PEs and all of a sudden a year later they're 4 PEs. And one of the reasons we don't use PE for a bank is for that reason. So I want to compliment that point. And then, did you run a sensitivity? Because while I respect the fact that UD is growing at 5, 6, 7% per
Mhm.
years, if you run that for infinity, do you realize then all of us will live in India or they will dominate us? They become our lords and masters. And so the problem with using a 5-5, even if it's the historical norm for 50 years, and I think this is a teaching point in a country, is running that for infinity, which is the terminal value. That's what it does. It eventually causes the company to become so large that it represents it approximates the GDP of the entire planet. And so one of the things you have to be careful of is not falling in the trap of saying, since the GDP has been that way, I'm just going to model mine that way. So did you run a sensitivity analysis at 3%? And can you tell us what it's worth?
I didn't go as low as 3%, but I did go as low as 1% under in terms of up and over.
1.5%.
Yeah.
Okay, I saw other hands. Who else had a question? Right there, Andy.
Yeah, so you say it's one of the largest private sector banks in India.
Mhm.
Well, the private sector only accounts for 16%, while state-owned is 72% in
Mhm.
India. Can you just talk about this and what that might have?
Yeah, sure. So there is a lot of government-owned banks within India. I guess that is somewhat of a control issue in terms of being able to write off things like recently, like farm loan waivers have been somewhat of an issue. So
Nick, last question.
So at that 4.5% terminal growth rate, what target value?
4.5%. 5% was 131 with a cost of equity of 6.21%.
We do have a question that came in on
No, that
YouTube.
5%. Right, thanks.
We have a question on YouTube. Shay?
Yeah, Nick Guerin wants to know if you can expand a little more on the increasing agricultural loan waivers.
Sure. So it has been somewhat of an issue. However, their exposure to these loan waivers are minimal. So overall, in terms of the amount of loans and, loans to whom they're making, I don't see it as much of an issue.
All right, Daniel, thank you. All right, final presentation of the day is going to be Ben Schmidt with Cactus, another energy firm. So juniors or sophomores? This will be you next year, all right? And these guys didn't take big, but pretty impressive, right? Yeah. So your classes matter, you'll learn a lot for next year. You'll be up there. You do it, right, Chris?
Well, we'll see.
Should I take a picture before you start crying?
Oh, yeah. My mom would like that.
You are photogenic.
Thanks.
All right, this is about ready. Oh, this will be the last pitch of the day. So before we start, thanks for coming. Glad you could see this. Sophomores, I know you're interested in finding out. We still have a few more interviews we have to catch up with for everyone that didn't make it last Saturday. So we're aware you're anxious to know the outcome. We're working on it. Okay? And we'll get back to you ASAP. Bill, you all set? One moment. Cactus, creative name there, Ben?
Yeah, you know it. Texas. All right, good afternoon. My name is Ben Schmidt. I'm a junior in the AIM program covering international and domestic energy like Connor. Today I'll be pitching Cactus Inc, ticker WHD. I'm going to start with my screening process. I didn't want to do an E&P because I don't want to be directly related to oil prices. I wanted to be like a derivative away, so I had a little bit less exposure. I also wanted to be like the lone supplier of a product. So rather than being in the business of competing wood manufacturers for tables, I'd be the one supplying the wood. I thought I found that with Cactus because they manufacture highly engineered products that aid in the drilling, completion, and production of a well. They have three main segments: products, rental, and field services. I also want to note on the revenue that they do all the revenue on a bid-by-bid basis. They were founded in 2011 and located in Houston, Texas. Since 2011, they have grown their followed rig count from 15 to 295 rigs. And even better with that statistic, since June 2016 to December 2018, rigs have grown from 368 to 1,045, which is a growth rate of 183%. Followed rigs for Cactus grew from 68 to 295, representing 334% growth, showing their ability to beat out its competitors. The TAM for upstream oil drillers is currently 280 billion and expected to grow 11% year over year. Similar to rig growth, wells drilled expanded from 14,290 to about 24,500 from 2016 to 2018. Because of these two factors, LTM revenue was 509 million as of 3Q18, growing at a 50% CAGR over the past 3 years if you take 2016, 2017, and 2018 estimated. In addition, the global market supply should be decreasing a little bit because of OPEC and its non-affiliates cutting supply by 1.2 million barrels as of last month, in addition to Canada cutting about their production by about 325,000 barrels per day. With a favorable domestic and international environment, it is recommended that Cactus be added to the AIM equity fund at a price target of $39.78 with an upside of 6.34%. 30 days. As we all know, oil prices plummeted in 2014, halting almost all capital investment. Midstream takeaway capacity stayed the same, but production still rose at great rates, creating bottlenecks primarily in the Permian Basin. Cactus is currently going all into the Permian Basin in anticipation of this takeaway capacity coming online. They expanded their capacity in Bossier, Louisiana, one of their main production facilities, and also bought a facility in Hobbs, New Mexico to service the Permian when this production comes online. As evidenced by the prior growth over the past 2.5 years with rig